Picture yourself pulling off the M1 or the M6. Tired after 2 hours of driving, the fuel light blinking, the kids asking for food, and you swing into one of those familiar service stations. The ones with the big signs visible from half a mile away, the ones that all seem to have the same collection of Costa and McDonald's and W.H. Smith and BP arranged around a building that looks like it could be anywhere in the country. And you pay £4.50 for a coffee and £6 for a sandwich, and you fill up your tank at a price per liter that is noticeably, sometimes painfully higher than what you passed at the last supermarket forecourt 5 miles before you joined the motorway, and you get back in your car and drive away. And never once think about what is actually happening financially inside that building and across that site. Who actually owns it? How the money actually flows? Why the prices are what they are? And what the genuine structural economics of operating one of these businesses actually look like underneath the surface that millions of British motorists interact with every single week without ever really seeing. Because a motorway service station is not simply a petrol station with a food court attached, it is a genuinely distinctive, genuinely complex business model shaped by a regulatory framework that is unlike almost anything else. In British commercial property, by a tenant and concession structure that distributes revenue in ways that most customers would never guess, by capital requirements that are enormous and largely invisible, and by a competitive dynamic that is, paradoxically, both extremely limited and extremely intense at the same time. Understanding all of that, understanding how the money actually moves through one of these sites, from the moment you pull off the motorway to the moment you pull back on, is what this entire breakdown is built around. And if that kind of honest, structural analysis of how real British businesses actually work behind the scenes is the kind of thing you find genuinely useful, then subscribe to Money Framework British and turn on notifications right now so you never miss the next one. Let us start with the single most important structural fact about motorway service stations in Britain, the one that shapes virtually every other aspect of the economics, and that is the regulatory and planning framework that governs where they can exist, who can operate them, and what they are required to provide. Motorway service areas in England are governed by a specific policy framework set by the Department for Transport. And under this framework, service areas must be provided at intervals along the motorway network to ensure that drivers have access to rest facilities, fuel and food within a reasonable distance. A policy rooted fundamentally in road safety rather than commercial convenience. Because the evidence is clear and well established that driver fatigue is a genuine, serious cause of motorway accidents, and providing regular opportunities for drivers to stop, rest, eat, and refuel is treated as a matter of public safety infrastructure, rather than simply a commercial opportunity. This means that the right to operate a motorway service station is not something an entrepreneur can simply decide to pursue by finding a suitable piece of land next to a motorway junction and building a facility, the way you might open a restaurant or a retail shop on any suitable high street premises you could find and lease. Motorway service areas require specific planning consent that is granted within this broader policy framework. And the number of sites along any given stretch of motorway is effectively fixed by this framework, meaning the total number of motorway service stations in Britain is genuinely limited, not by market demand, but by regulatory design, and new sites are added only rarely. When a specific gap in coverage along a particular stretch of motorway is identified and approved through the formal planning process. This regulatory scarcity is, in practice, the single most important economic characteristic of the entire business, because it means that an existing, operating motorway service station faces almost no risk of a direct new competitor opening next door. a competitive protection that is almost unheard of in any other segment of British retail or hospitality. And that gives the site operator a degree of pricing power and demand certainty that most other businesses in these sectors would find genuinely extraordinary. Now, who actually owns and operates these sites? Because the ownership structure of British motorway service stations is considerably more concentrated than most people realize. The overwhelming majority of motorway service areas in Britain are operated by just 3 companies: Welcome Brake, Moto, and Road Chef, with a smaller number operated by Extra and a handful of individual, independently operated sites. This means the entire motorway services sector in Britain is effectively an oligopoly, a market dominated by a very small number of very large operators, each of whom controls a portfolio of sites distributed across the national motorway network, and each of whom has built their business model around the specific, distinctive economics that this breakdown is going to walk through in detail. Behind these operating companies sit institutional investors, private equity firms, and infrastructure funds who view motorway service stations not primarily as hospitality businesses, but as infrastructure assets. Long-lived, regulated, essential use properties with highly predictable demand characteristics that make them attractive to exactly the kind of patient, yield-seeking capital that also invests in toll roads, utilities, and other regulated infrastructure. A classification that tells you something genuinely important about how the financial markets actually view this business, which is that they view it less like a restaurant chain and more like a piece of transport infrastructure that happens to generate its returns through retail and food sales, rather than through a direct user toll. Now let us talk about how the money actually flows through a motorway service station, because this is where the business model becomes genuinely interesting and genuinely different from what most people assume when they are standing in the queue for their coffee. The most visible revenue stream, and the one most customers assume is the primary source of profit, is fuel. Because the petrol station forecourt is typically the largest single physical element of the site, and fuel sales represent a very large absolute number in terms of total revenue passing through the business. But here is the crucial thing. Most people do not understand about fuel economics at a motorway service station. Fuel margins are thin, genuinely thin, typically only a few pence per liter. And while the volume of fuel sold at a busy motorway site is enormous, the actual profit generated per liter is a fraction of what most customers assume when they notice the premium they are paying relative to supermarket forecourt prices. The premium price you pay for motorway fuel, and it is a genuine, consistent premium, typically 10 to 15 pence per liter above supermarket prices, and sometimes more, does translate into somewhat better margins than a supermarket forecourt achieves. But the site operator's fuel margin still has to cover the substantial cost of operating a large staffed forecourt facility that is open 24 hours a day, 365 days a year, plus the capital cost of the tanks, pumps, canopy, and environmental compliance infrastructure that a modern fuel forecourt requires, meaning the net profit contribution from fuel, while not negligible, is considerably smaller than the gross revenue number would suggest. The real profit engine of a motorway service station, the part of the business that actually generates the margins that make the whole operation financially viable, is not fuel at all. It is the food, beverage, and retail operation inside the main building, and more specifically, it is the rental and concession income the site operator receives from the branded tenants who occupy space within that building. This is the part that genuinely surprises most people when they first understand it. Because when you walk into a motorway service station and buy a coffee from Costa, or a meal from McDonald's, or a book from W.H. Smith, you're not buying from the service station operator. You are buying from a branded concession tenant who is operating their own outlet within space leased from the site operator, and paying the site operator a combination of base rent and turnover rent, meaning a percentage of their actual sales revenue, for the right to trade from that location. This concession model is the structural heart of the motorway service station's economics, because it means the site operator is not primarily in the business of making and selling coffee or sandwiches or magazines themselves. They are primarily in the business of providing a captive, high-footfall location to branded retail and food tenants who are willing to pay a genuine premium for access to a customer base that is, by the nature of motorway driving patterns, essentially guaranteed to arrive in large, predictable numbers every single day with very limited alternative options for the duration of their journey. The turnover rent structure is particularly important here because it means the site operator's income from their tenants rises and falls directly with the tenant's own sales performance, creating a natural alignment of interest between operator and tenant, but also meaning the operator's revenue is directly exposed to anything that affects the volume or spending patterns of motorway traffic, a point we will return to shortly. Now, the prices. Because this is the thing that generates more customer complaint and more public discussion than almost any other aspect of motorway services. And understanding why prices are what they are requires understanding the specific cost structure that sits underneath them. Motorway service station prices for food, beverages, and retail goods are consistently, measurably higher than high street or supermarket equivalents. And this premium is not primarily driven by greed or exploitation, though it is understandable why customers perceive it that way. It is driven by a combination of genuinely higher operating costs and the specific, captive market dynamics this breakdown has already described. The operating costs of a motorway service station are genuinely, structurally higher than a comparable high street outlet for several important reasons. The site must operate 24 hours a day, every single day of the year, a requirement that flows directly from the road safety obligation described earlier. Meaning staffing costs include full night shift coverage, weekend and bank holiday premium rates, and the overhead of maintaining a fully lit, heated, cleaned, and staffed facility through the small hours of the morning when customer numbers are very low, but the facility must remain open and operational regardless. The site is typically located in a relatively remote position between motorway junctions, meaning staff recruitment draws from a limited local area and often requires the operator to offer transport assistance or shift patterns that accommodate workers who may have limited public transport options for reaching the site, adding a practical cost and complexity to staffing that a town center outlet simply does not face, and the sheer physical scale of the site. Large car parks, extensive landscaping, heavy-duty drainage and waste management infrastructure. All of this carries a maintenance and operating cost that is considerably higher than most retail or food service operations of comparable revenue. All of these costs flow through to the prices charged to customers. Amplified by the captive market dynamic, the simple, structural reality that a driver on the motorway who needs fuel or food or toilet break has in most cases no practical alternative within a reasonable distance, giving the operator pricing power that a high street competitor, surrounded by alternatives, simply does not possess. If understanding these kinds of hidden structural dynamics behind businesses you interact with every day is genuinely useful to you, Money Framework British is built specifically for exactly this. So make sure you are subscribed and have notifications turned on. Now let us talk about the capital cost of actually building or acquiring a motorway service station. Because the numbers involved are genuinely, startlingly large, and understanding them is essential to understanding why this industry is dominated by large institutional operators rather than individual entrepreneurs. A new build motorway service area, developed from scratch on a greenfield site adjacent to the motorway, typically requires a total capital investment measured in tens of millions of pounds, encompassing land acquisition, planning and regulatory compliance costs, the construction of the main building, the fuel forecourt, extensive car parking for cars, coaches, and heavy goods vehicles, landscaping, drainage, utility connections, and the fit out of individual concession units to the standards required by the branded tenants who will occupy them. Even acquiring an existing, already operational site involves a purchase price that reflects the capitalized value of the site's future income stream. And given the regulatory scarcity and demand predictability described earlier, these capitalized values are very high, meaning the buyer needs access to the kind of large-scale institutional financing that is available to private equity-backed operators and infrastructure funds. But that would be essentially impossible for a smaller, independent operator to secure. This capital intensity is the primary reason the industry is structured as it is, dominated by a small number of large portfolio operators backed by institutional capital, because the scale of investment required to enter the market, combined with the regulatory barriers to creating new sites, creates a genuinely formidable barrier to entry that effectively excludes all but the most heavily capitalized potential participants. Now, traffic volume and its relationship to revenue, because this is the variable that drives everything else in the financial model. A motorway service station's revenue is, at the most fundamental level, a direct function of how many vehicles pass the site on the adjacent motorway and what proportion of those vehicles choose to stop. Traffic volume on major British motorways is enormous. The M25, M1, M6, and M4 each carry tens of millions of vehicle movements per year. And even a modest capture rate, the percentage of passing vehicles that actually exit the motorway and enter the service area, generates very large absolute visitor numbers. But capture rate is not fixed. It varies with the time of day, the day of the week, the time of year, the weather, the distance to the next alternative stopping point, and increasingly, the driver's own advance awareness of what facilities and brands are available at the site, meaning the site operator has a genuine, ongoing incentive to invest in the quality, variety, and visibility of their offer in order to maximize the proportion of passing traffic that actually chooses to stop. This is why you have seen, over the past decade or so, a genuine, visible investment in the quality and range of food and retail offerings at many motorway service stations. A shift away from the historically poor reputation of motorway services food toward branded, recognizable, higher quality options that give drivers a positive reason to stop rather than simply stopping because they have no alternative. A shift driven not by altruism but by the hard commercial logic that a better offer increases capture rate, and increased capture rate flows directly through to higher concession revenue for the site operator. Now, electric vehicle charging, because this is a development that is actively, visibly reshaping the physical layout and the revenue model of motorway service stations in real time, and understanding its economic implications is essential to understanding where this business is heading. The transition from petrol and diesel vehicles to electric vehicles changes the motorway service station's economics in several genuinely important ways. First, an electric vehicle charge takes considerably longer than a fuel fill, even with rapid chargers. Meaning an EV driver who stops to charge is likely to spend 20 to 40 minutes on site rather than the 5 to 10 minutes a conventional refueling stop requires. And that additional dwell time directly increases the probability and the value of secondary spending on food, beverages, and retail during the stop. potentially making an EV driver a more valuable customer to the site's concession tenants than a conventional fuel customer, even if the direct margin on the electricity itself is lower than the margin on petrol or diesel. Second, installing the electrical infrastructure required to support a large bank of rapid EV chargers. The grid connection upgrades, the transformers, the cabling, and the chargers themselves requires a significant additional capital investment that the site operator must either fund directly or accommodate through a partnership or concession arrangement with a dedicated charging network operator, adding a new layer of capital allocation decision-making to the site's financial management. Third, and perhaps most fundamentally, the long-term shift toward electric vehicles raises a genuine strategic question about the future role of the fuel forecourt itself. Currently, the most physically prominent element of the site in the overall business model. Because as the proportion of vehicles requiring conventional fuel declines over the coming decades, the site operator will need to progressively repurpose forecourt space toward EV charging and potentially other uses, a transition that requires careful planning, significant investment, and a willingness to manage genuinely uncertain long-term demand projections for both conventional fuel and electric charging simultaneously. Now, heavy goods vehicles. Because the HGV facilities at a motorway service station represent a genuinely important, often underappreciated segment of the site's overall economics. Professional truck drivers are legally required to take regular rest breaks, and motorway service areas provide the designated stopping points where these breaks can be taken in compliance with drivers' hours regulations. Meaning HGV parking and facilities at motorway services are not simply a commercial amenity. They are a regulatory necessity that generates a specific, predictable demand base largely independent of the discretionary holiday and leisure traffic that drives the car park side of the business. HGV parking is typically charged, often on an overnight basis, and the provision of shower facilities, dedicated HGV food service, and in some cases more extensive truck stop amenities generates a secondary revenue stream from professional drivers whose stopping patterns are driven by regulation rather than discretion, providing a degree of revenue stability and predictability that complements the more variable, more seasonal pattern of car-based visitor traffic. Now, the property value itself, because understanding how the financial markets actually value a motorway service station is essential to understanding why institutional investors are willing to pay such high prices for these assets, and why the sector is structured the way it is. A motorway service station is valued fundamentally as a long-lived infrastructure asset generating a predictable, inflation-linked income stream from a combination of fuel sales, concession rents, and ancillary revenues, including parking charges and advertising. The regulatory scarcity described at the beginning of this breakdown, the fact that new competing sites essentially cannot be built nearby, provides a degree of income protection that is extremely unusual in commercial property. And this protection is reflected directly in the valuation multiples that investors are willing to pay. Multiples that are typically considerably higher than those applied to conventional retail or hospitality properties, where new competition can emerge at any time. This is why private equity firms and infrastructure funds have been the dominant buyers and holders of motorway service station portfolios in Britain. Because the combination of predictable demand, regulatory protection from new competition, inflation-linked revenue streams, and essential use characteristics matches almost perfectly the investment profile these funds are designed to target and the returns these assets generate, while not spectacular on an annual basis, are remarkably stable and remarkably predictable over long holding periods, which is exactly what patient institutional capital is looking for. Now, the customer experience question, and why it matters economically rather than simply as a matter of comfort or preference. The historic reputation of British motorway services has not been kind. Decades of genuinely poor food, dirty facilities, and indifferent service created a deeply embedded public perception that motorway services were places to be endured rather than enjoyed. A perception that actively suppressed capture rates because drivers who could possibly avoid stopping would choose to do so, rather than subject themselves to a disappointing experience. The investment in improved facilities, better branded food options, cleaner environments, and in some cases, genuinely ambitious architectural and design improvements at newer or recently refurbished sites is a direct, commercially motivated response to this perception problem, driven by the hard economic reality that every percentage point improvement in capture rate, every additional driver who chooses to stop because the offer is genuinely appealing rather than merely tolerable, flows directly through to the site operator's concession revenue and ultimately to the site's capital value. This is commercial self-interest operating in exactly the direction that benefits the customer. A dynamic that is worth recognizing honestly because it explains why the quality of motorway services in Britain has genuinely, measurably improved over the past decade, even in the absence of any regulatory requirement for it to do so. There is also a planning and development wrinkle worth understanding, which is that the land immediately around a motorway service area is often subject to specific planning restrictions that limit what it can be used for, preventing the site operator from simply developing the surrounding land for general retail, residential, or commercial use that might generate higher returns than the service station itself. This means the operator is, in most cases, constrained to generating returns exclusively from the service area operation itself, unable to unlock additional land value through alternative development, even where the site's motorway-adjacent location would make such development commercially attractive, a constraint that further reinforces the importance of maximizing the revenue and efficiency of the core service station operation within its permitted use. So let us put all of this together and look at what the complete financial picture of a British motorway service station actually looks like when you strip away the branded signage and the familiar layout and look at the raw mechanics underneath. You have a business operating from a site whose right to exist is controlled by regulatory framework rather than market forces, creating genuine scarcity value and near total protection from direct new competition. You have a revenue model built primarily not on fuel margins, but on concession income from branded tenants paying base and turnover rent for access to a captive, high-footfall customer base. You have enormous capital requirements for site development or acquisition, restricting ownership to large, institutionally backed operators. You have operating costs that are structurally higher than comparable high street or retail park operations due to 24-hour operating obligations, remote locations, and the physical scale of the sites themselves. You have a demand base that is enormous, predictable in aggregate, but variable in its capture rate depending on the quality and attractiveness of the offer. And you have a long-term structural transition underway as electric vehicles progressively reshape both the physical layout and the revenue composition of the entire operation. The operators who succeed in this environment, and the 3 or 4 major operators who dominate the British market have clearly succeeded by any financial measure, are the ones who understand that they are not really in the business of selling fuel or sandwiches. They are in the business of owning and operating a scarce, regulated piece of transport infrastructure and extracting maximum value from the captive demand that infrastructure generates through careful tenant selection, continuous investment in the quality of the customer offer, and disciplined management of the very large, very complex physical assets they control. If you found this breakdown genuinely useful, if seeing the real structural economics underneath a business that millions of people use every week without ever really understanding how it works is the kind of analysis you want more of. Then Money Framework British is the channel built specifically for exactly that. Subscribe now, turn on notifications, and the next deep dive into how a real British business actually works behind the scenes will come directly to